I'm going to work through this example with you. Now, the year end is 31 December 20.17. During the current financial year ended 31 December 20.17, the accounting policy for the assignment of cost to inventory was changed from your first in, first out formula to your weighted average formula. Since management was of the opinion that the financial statements will provide reliable and more relevant information when the weighted average formula is applied. Now, the first question, is this an involuntary or 2, is this a voluntary change? This will be a voluntary change. Therefore, if it's a voluntary change, you need to know we will have to adjust this retrospectively going backwards. Therefore, for the current financial year, for the prior financial year, our comparative figures, and then important, we need to adjust for our opening balance for 20.16, and therefore this will be our closing balance of 20.15. Then they indicate to us, the newly appointed accountant adjusted the financial statements for the current and previous financial years to account for the change in accounting policy retrospectively. Yes, we know that this is what they have to do. Since it was not possible for the accountant to determine the weighted average cost of the inventory at 31 December 20.16 and prior periods, the newly appointed accountant used estimated values. Now, my question, guys, what is the correct treatment of this? They've indicated to us that it was not possible to determine the weighted average at the end of 20.16. Therefore, we could not use the weighted average at the end of 20.15, but they've still applied this retrospectively and they have performed estimates to the values. Now, guys, remember that there is your limitations paragraph included in your changes in accounting policies. The requirement indicates that you need to advise the newly appointed accountant on the correct accounting treatment of the mentioned items in accordance with IAS 8 for the year ended 31 December 20.17. Now, how do we attempt a theory question? Remember, tag principle, include the theory from the paragraphs, apply this to the information provided, and then remember to conclude. Now, important guys, you had to identify if this is voluntary or non-voluntary. So I've only transferred this table to a new page. We have indicated that an entity may change their accounting policy if it results in fair and reliable presentation. Therefore, guys, they've indicated that this is what they're going to do. Therefore, yes, they may change their accounting policy. Now, due to the fact that this will be a voluntary change, we need to correct this technically retrospectively. Therefore, we will have to adjust our closing balance for 20.15 and this will be our opening balance for 20.16, except when there's limitations and that we cannot obtain all of the information. Therefore, it is impracticable to do this, and the standard then indicates to us that we may apply this going forward prospectively from the earliest date possible. Therefore, important, our opening balance will be based on our old accounting policy and our closing balance will be based on our new accounting policy, and we need to remember to disclose the fact. Guys, I want you to work through the solution. Ensure that you understand this. I think this is a good theory question on IAS 8 and you need to be able to answer similar theory questions. The fact that the opening inventory will be valued on the first in, first out method. No adjustments will be made against the opening balance of retained earnings on the 1st of January.